the first cut in the dividend since World War II. Do you feel the weight of history then as you make this decision at Shell?
Of course, Anna, and thank you very much for having me. It's of course a difficult day, but on the other hand, it is also an inevitable moment. We are basically facing two problems. One, of course, is the very poor macroeconomic environment, which is getting worse. But the other problem, which is probably even bigger, is that we basically have a crisis of uncertainty. Uncertainty about demand, about prices, maybe even uncertainty about the viability of some of our assets, given all the logistical issues that we have. So we have taken some very strong and early countermeasures to protect the financial resilience of our company. And you've seen before that we have taken a reduction in capital cost and operating cost, $8 to $9 billion over 12 months. But frankly speaking, these countermeasures are not enough to deal with the unprecedented uncertainty that we are seeing. So the board has decided that it was prudent to also reduce the dividend. And then early this morning, we have decided to reset the dividend to 16 cents going forward, which is still a meaningful dividend and an affordable dividend, Anna.
And you won't continue with the next tranche of your buyback either, Ben. Let me ask about your debt. A lot of companies and countries are having to deal with much higher gearing. You were already at your comfort level before this crisis, but changes are going to have to be made, I guess, to our comfort levels here. How high do you expect your gearing to go, and when do you want to turn it around and start bringing it back down?
Very good question, Matt. And indeed, when I talk about financial resilience, which is, I think, the key thing to protect with such an uncertain outlook, it is both about the debt levels that we feel are appropriate, but also the liquidity that we have. Now, our debt levels are outside the range that we would consider to be normal over the cycle. We end up at a gearing slightly less than 29%. We would really like to be below 25%. And of course, in the next quarters and perhaps years, depending a little bit on how this plays out, we will do everything to get our gearing back in the range that we need to have. Liquidity is fine. We do not have to worry about that. We have more than $30 billion of liquid funds to have access to. But the point is, we have to protect these levels of financial resilience. And that's why we had to take these very drastic countermeasures, and we had to take them early, and we had to take them decisively. But at this point in time, I would expect our gearing to stay slightly elevated, not at the level, though, that we should be concerned.
Okay, and you've told us then why you've had to take these tough decisions, Ben, around the dividend. But do you think you might have trouble attracting long-term shareholders to the oil sector if we see lower dividends from the sector, a lower dividend from Shell?
Well, I think it's fair enough that of course our dividend yield will no doubt come down. But then again, our dividend yield was at a level that very clearly also signaled to the market that our dividend was seen to be at risk. So now that risk is basically out of the way, of course, we enter into a new phase. The fact that we have reset our dividend to a level that we believe is affordable, and the fact that we have created through our strong and early countermeasures room to maneuver, to continue to invest in value growth, to protect the value of the company, to look forward to what the energy transition can bring us, and to continue to invest in that energy transition, I believe will make us a very strong investment case going forward. But no doubt, this is a tough day. It's a tough day for all of us, particularly, of course, for those investors that invest in us for the income that we provide.
Do you think you maybe in the past have overpromised on the dividend, Ben? And are you suggesting it won't fall at all from here?
Well, as I said, the biggest crisis we feel is actually the crisis of uncertainty. And that's why, as I said, financial resilience is so important. What we have been doing is to look at a whole range of potential scenarios that can hit us, and basically figured out what would need to happen for this dividend not to be sustainable. The fact that we cut all the way down to 16 cents per share, so a 66% cut, I hope will also signal that we have taken quite a bleak scenario into account. But having said that, of course, we don't know how this pandemic will play out. We don't know what will be on the other side of this pandemic. And therefore, there are no guarantees in life. But I feel very confident that the measures that we have taken, $8 to $9 billion of countermeasures in terms of capital cost and operating costs, and then more than $9 billion in outgoings in terms of dividend, between the two of them, and this is on an annual basis, between the two of them will give us a lot of room to maneuver, particularly also, of course, as we have sufficient liquidity and even a bit of headroom if you really wanted to in terms of net debt levels.
Ben, speaking of liquidity and room to maneuver, I wonder about storage. Have you had any difficulty finding space to put your oil once you pull it out of the ground?
Well, Matt, that's a very good question, because I think indeed the feasibility of operations is going to be a very important determinant going forward. And what you have seen, and this is of course why we also saw negative prices on WTI contract, what you have seen indeed is that the viability of storing, whether it is crude or even evacuating kerosene from refineries into markets that basically don't exist anymore, these are going to be important determinants whether assets can continue to operate. So far, we have been able to mitigate these risks. We, of course, have one of the largest trading networks in the world. We have one of the largest logistics networks in the world. And of course, a lot of focus is on the viability, the continued viability of our operations. So to use a bit of jargon, no, we have had no issue with flow assurance, as we call it. But of course, it is a threat that is clearly around. And we have to see, unfortunately, oil prices probably go to levels that people are forced to take the very tough decision to close in production or to close in a refining capacity. I think the fact that we are integrated, the fact that we have such an amazing capability in our trading and supply operation means that we have not needed to go that far. And we continue to look, of course, on opportunities to enhance our storage position, to enhance our flexibility. But that will be something that everybody in the industry is doing at the same time as well.
I'll tell you, the prices haven't hit the pump yet. I'm still paying over 100 euros to fill up my truck with V-Power. But I'm usually the only person at the station, Ben. Has demand fallen to a point where you're stopping production? Or let me ask you another way. How much production have you cut due to the drop in demand? If
you look at the pump first, Matt, and I'm of course very pleased to hear that you fill up with V-Power as I do. But the drop at the pump so far, if you look at the last weeks of March and even in April, what we have been seeing is that the drop in volumes we have been able to offset through good margin management, but also to make sure that the customer value proposition at some of our retail sites is replaced. We have changed out the offerings that we have in our convenience stores. We have even changed our operating models. We even go as far as to do home deliveries from retail sites around the world. So I think so far, what we have seen in the results for the quarter is actually a very strong performance from our marketing business. Also, by the way, a very strong performance from our integrated gas business, so LNG. So that's good for resilience. At the same time, yes, of course, we do see also pressure on the viability of our assets. So we have had, in some cases, some turnbacks or turndowns of our refining capability. We have the odd crude still out of service here and there where it doesn't make sense anymore to run that. We have indeed also shut in some wells in areas where this has become marginal or actually cash negative. And if you go into Q2, we expect more of that. But it's going to be a mix of factors. Some of it will be basically driven by OPEC++. We will be compelled by sovereign desires to cut our production here and there. We expect it to be roughly 40% of the drop that we will see in Q2. We will indeed make economic decisions to leave the oil and gas in the ground and take it out later. And then I think there will be some practical, logistical, and other technical issues related to COVID-19, and that's another 20%. But altogether, potentially up to a third reduction in volumes on the production side, Matt.
Let me ask you about OPEC countries that you operate in, Ben, and whether you're being asked by them to cut back on production. You've set out your plans there for us, but what are the conversations like with members of OPEC?
Well, that's of course a matter for the OPEC++ countries. The way it works, of course, we do not participate in any coordination of cuts. We cannot and we will not. This is a matter for sovereign states. And of course, it would violate antitrust legislation for us to participate in it. So we are basically in receiving mode. We, as much as possible, operate within the production sharing contracts or other legal constructs that we have in countries. And if we are being compelled to reduce, then that has to be on the basis of a legal instruction to do so. So we stay out of that for obvious reasons, both economically as well as from an antitrust and legal perspective.
I wonder what you think is going to permanently change here, Ben. I mean, I can imagine when this crisis starts to abate, fewer people going back into the skies and a lot more people taking trips on the road. Do you think there are going to be some, I don't know if permanent's the right word, but maybe serious midterm changes here?
Matt, we have to assume that will be the case. And as I said, it's the operative word here is assume, because nobody can tell for sure. First of all, we don't know how the pandemic will play out, unfortunately. Secondly, we do not know whether attitudes and practices of people will be permanently altered. My expectation is that they will be altered for some time to come, whether that is because of the economic bandwidth that people will have or businesses will have, or whether it is because of attitudes where people want to take different risks when they travel or when they go on holiday, or perhaps when they actually rediscover the convenience of working from home or working remotely. So yes, my expectation is that there will be changes. And therefore, we have to be ready for that. That means that we probably have to reestablish what is going to be our strategy going forward. But we can, of course, only do that as we see a little bit more into the future, what that future will hold. But it would be too naive at this point in time to say, we know what is happening, this is just another downturn, things will bounce back, and we will get to where we were before. I think that would be an inappropriate conclusion to draw at this point in time.
Ben, we're just a few minutes into the start of the European trading day. As we've been talking, it started, of course. The Shell share price falling some 3.5% out of the gates after the cut to your dividend. Is that to be expected? Do you understand that some investors are going to feel disappointed, maybe even feel that they had not expected this to happen today?
No, I understand that this is going to be a very difficult day for our investors. It is going to be a particularly difficult day, of course, for investors that are in our stock for income reasons. And that's both the large funds, but particularly also retail investors. They will feel it. And believe me, I feel with them the pain that this causes. I hope it doesn't come as a surprise that measures like this need to be taken in order to ensure the viability and the future value of our company. And I also expect, by the way, Anna, that as the quarter wears on and as people will see the extent of the further uncertainty play out and the destruction of demand, the uncertainty of assets viability, etc., that it will be seen indeed as the only prudent, and even responsible step to take. The board was very clear they would consider it irresponsible to borrow to pay a dividend that is fundamentally, under the current circumstances, not sustainable. That can't be in the interest of any shareholder either.
I just wonder, Ben, if you're worried about coming under pressure for your job. Are you worried that shareholders are going to rally to get you to resign? Would you resign over the cut of the dividend? I mean, it is an historical issue.
It is a historical issue, absolutely. And as I said, it's a difficult moment, a difficult day. But then again, it is the responsible thing to do, and it is a logical thing to do. It is an action that is there is no alternative to it. It is a matter of prudence. You could argue do it now or do it later. I think you better do these things early so that you actually preserve resilience rather than having to worry about how you rebuild resilience. So I think the board has taken a responsible decision. It has taken a prudent decision, and let's see how shareholders respond to that.